Market trends are among the most fundamental aspects of financial markets. We can define a market trend as the overall direction that an asset or a market is going, and as such, market trends are closely watched by both technical analysis and fundamental analysis analysts. Bull markets tend to be relatively straightforward, though, as they can allow for some of the easiest trading and investment strategies, and even inexperienced traders might do well in a favorable bull market with favorable conditions. Now, with that said, it is also crucial to understand how markets move in cycles. So, what should you know about bull markets? How can traders take advantage of said bull markets? We're going to explain that in this lesson. Now, what is a bull market? A bull market or a bull run is a state of a financial market where prices are rising. The term bull market is often used in the context of the stock market. However, it can be used in any financial market, including Forex, bonds, commodities, real estate, and cryptocurrencies. Now, besides, a bull market may also refer to a specific asset such as Bitcoin, Ethereum, or even Cardano or DOT or anything like that. It could even refer to a sector such as utility tokens, privacy coins, or biotech stocks. So the range really varies. Now, you might have heard traders from Wall Street use the terms bullish and bearish. When a trader says they are bullish on a market, it means that they expect prices to rise. When they are bearish, they expect prices to decline. Being bullish can often mean that they are also long on the market, meaning they have interest in the market, though that may not necessarily be the case. Being bullish may not necessarily mean that a long trade opportunity is present right now, just that prices are rising and are expected to continue to rise. It's also worth noting that a bull market doesn't mean that prices don't fall or fluctuate. This is why it's more sensible to consider bull markets on larger time frames. In this sense, bull markets will contain periods of decline or consolidation without breaking the major market trend. Take a look at the Bitcoin chart here. While there are periods of decline and a few violent market crashes, it's been in a major uptrend ever since the very beginning. So in this sense, the definition of a bull market depends on what time frame we're talking about. Generally, when we're using the term bull market, we're talking about a time frame of months or years. As with other market analysis techniques, higher time frame trends will have more validity than those of lower time frames. And as such, there may be prolonged periods of decline in a high time frame bull market. These counter trend price movements have a notoriety for being especially volatile, though this can vary greatly. Now, bull market examples. Some of the most well-known examples of bull markets come from the stock market. These are the times when stock prices and market indexes such as the NASDAQ are continuously rising. As far as the global economy is concerned, it fluctuates between bull and bear markets. These economic cycles can last for years, even decades. Okay, so bull market versus bear market. What's the difference? These are opposite concepts, so the difference isn't too tough to guess what it is. Prices are continuously going up in a bull market, and prices are continuously going down in a bear market. This also results in differences in how it may be best to trade them. In a bull market, traders and investors will generally be wanting to go long, and in a bear market, they either want to be short or stay in cash or a stable coin like USDT. Staying in cash may also mean shorting the market since they are expecting prices to decline. The main difference is that staying in cash is much more about preserving capital, while shorting is about profiting off the decline in assets' prices. But if you sell an asset expecting to buy it back at a lower price, you're essentially in a short position, even if you're not directly profiting from the drop. One additional thing to consider is fees. So staying in stable coins will likely not incur any fees, as there typically isn't cost to holding custody of your own stable coins. However, many short positions will require a funding fee or interest rate to keep the position open. This is why quarterly futures may be ideal for long-term short positions, as there are no funding fees associated with them. So how can traders take advantage of bull markets? Well, the main idea behind trading bull markets is relatively simple. Prices are going up, so going long and buying dips is generally a reasonable strategy. This is why the buy and hold strategy and dollar cost averaging. Now, there's a saying that goes like this: the trend is your friend until the end. And that just means that it makes sense to trade with the direction of the market trend. At the same time, no trend will last forever, and the same strategy may not perform well in other parts of a market cycle. So the only certainty is that markets can and will change. As we've seen with this whole pandemic, multi-year bull markets can be wiped out in a matter of weeks. Naturally, most investors will be bullish in a bull market. This makes sense since prices are going up, so the overall sentiment should also be bullish. However, even during bull markets, some investors will be bearish. If their trading strategy accommodates for it, they may even be successful with short-term bearish as shorting. Now, some traders will try to short the recent highs in a bull market. However, these are advanced strategies and are generally more suitable for professional traders. As a less experienced trader, it is usually more sensible to trade according to the trend. Many investors get trapped trying to short bull markets, and after all, stepping in front of a raging bull or a locomotive can be a pretty damn dangerous undertaking. All right, so as we've discussed, we know what a bull market is. We know how traders may approach trading in said bull markets, and typically the most straightforward trading strategy in any market trend is to follow the direction of said overall trend. As such, bull markets may present good trading opportunities even for beginners or first-time investors. However, it's always essential to manage your risk and keep learning how to avoid mistakes as much as possible. Capital preservation and risk management, that is the main focus of this entire course.